Ladies and gentlemen, good day and welcome to Q2 FY23 earnings call for Godawari Power and Ispat Limited, hosted by Go India Advisors. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sana Kapoor from Go India Advisors. Thank you, and over to you.
Thank you, Aman. Good morning, everybody, and welcome to Godawari Power and Ispat Limited earnings call to discuss the Q2 and H1 FY23 results. We have on the call Mr. Abhishek Agarwal, Executive Director, Mr. Sanjay Bothra, Chief Financial Officer, and Mr. Dinesh Gandhi, Executive Director. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that the company faces. May I now request Mr. Dinesh Gandhi to take us through the company's business outlook and financial highlights, subsequent to which we will open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Sana. Good morning, ladies and gentlemen, and thank you for joining us with us on the earnings calls today for Godawari Power and Ispat Limited. I trust you have had look at the revised earnings presentation uploaded on the stock exchange and the company website. The presentation was required to be revised primarily on account of two errors in the presentation. One is relating to the H1 average selling price of the pellets sold, which has been revised, and number two is the capacity of another solar power project which is under construction, which was wrongly mentioned as 38 megawatt against 25 megawatt. So capacity continues to remain at 25 megawatt. I will briefly discuss the result, and then we can have the Q&A session after that. Before I discuss the quarterly performance and H1 performance in detail, I would like to discuss on the few strategic updates. As you are all aware, the State Pollution Control Authorities have granted us the consent to operate for the announced pellet capacity from 2.4 million ton to 2.7 million ton. With this, we are revising our guidance for production of iron ore pellet from 2.4 million ton to 2.6 million ton in FY23. For the H1 FY23, GPL is already 50% of the revised guided targeted capacity and produce about 1.31 million ton of pellet. Our capex guidance continues to remain at about 500 crore for the current year. We have already incurred 179 crore in the first half of 23. The guidance continues to remain same despite imposition of export duty, and these projects are primarily related to the cost saving and efficiency improvement related. The solar power project will help us improve our cost of power, grid power, which is more than 5 rupees 50 paisa per unit. Against that, our generation cost will be hardly at operating level at about 30-35 basis point. Similarly, the replacement of turbine will improve the power generation at the same operating cost. And the capex at the mining, would help us beneficiate the ore at the mine and reduce the cost of production for the company. The only project which we have kept on hold is the steel melting shop, where we are still, working on the revised capacity and the products to be manufactured, and after that we will make a suitable announcement in due course of time. Regarding the Greenfield steel project which the company had, announced earlier, the status continues to be, we have not yet been able to acquire the land, and the land acquisition is getting delayed. And we have filed for the environmental approval for the project, which is under consideration of the central ministry. Once the environmental approval land acquisition is done and environmental approval is received, we will be able to freeze our investment plan and will guide the market accordingly in due course of time. Coming on the performance, the market price of iron ore for Q2 FY23 is 4,500, whereas our captive blended iron ore cost is about 6,000 rupees a ton. This shows the competitive advantage of the captive iron ore that GPIL has. In Q2 FY23, GPIL iron ore mining and pellet production is increased by 34% and 17% on a YOY basis. Production of sponge iron, HB and galvanized fabricated products have also increased on YOY basis. However, production of ferroalloys has reduced primarily because the market for the ferroalloys has prices have gone down, and we took this opportunity to do a maintenance shutdown for the ferroalloys plant of Hira Ferroalloys and Alok Ferroalloys. Similarly, as you would have observed, our pellet realization has gone down by almost 3,500 rupees a ton as compared to the pellet realization in the Q1 FY23. And if you look at our numbers, the fall in profitability is mainly on account of the fall in pellet realization, because our cost of production remains same on account of the captive iron ore mining. And if you take the impact of the reduction in pellet selling price from about 11,500 to 8,000 something, 3,500 into 550,000 tons of the pellet comes to about 200 crore rupees. And to that extent, there is a fall in EBITDA of the company. And the fall in pellet realization is all, as you are all aware, is on account of imposition of export duty, and simultaneously reduction in the international selling price of iron ore prices, iron ore as Now, coming on the financial performance for Q2, consolidated revenue increased to 1,307 crore, up 303% YOY basis, but decreased 22% quarter-on-quarter basis. The main reason for decrease is majorly decrease in the realization of iron ore pellet. The total expenses, looks to be increased by 28% YOY. But actually, the expenses are looking higher on account of reduction in the selling price. So top line is higher. Expenses have not increased substantially. Expenses continues to remain at the same level, except the prices of coking coal on YOY basis. The consolidated EBITDA is 231 crore, which is down 50% quarter-on-quarter and 47% YOY basis. The drop, I've already explained, the drop in EBITDA is mainly on because of the fall in the prices of the iron ore pellet. Also, consolidated trade from continuing operation attributed to the owner is down 48% sequentially to 168 crores. Now, coming on the market outlook, starting with the international outlook, the iron ore prices have already fallen to about $80 from $158 as on 1st of April. The demand and consumption of steel and other commodities remain subdued due to, in China due to COVID and real estate crisis, and in the rest of the world due to interest rate hike and the energy crisis. Expectation is that in H2 FY23, things will improve due to China's stimulus to support economic growth. However, uncertainty remains due to China's zero COVID policy. Iron ore prices post correction are expected to stay in the range of $80 to $120 for the rest of the year. Also, import of iron ore pellet of China has reduced 33% in January to September 2022 compared to same period last year because of the sustained crude steel production cut and weak domestic outlook. Coming on the domestic outlook, government has levied export duty on iron ore from 30% to 50%, on pellet from nil to 45%, and steel from 0 to 15% in May 2022. This has led to sharp drop in the domestic iron ore prices. NMDC has cut its iron ore prices by approximately 2,000 rupees a ton. Iron ore production in FY23 is estimated to be lower. Pellet prices decreased from 14,000 rupees a ton in April to 7,450 rupees and is presently trading at about 8,000 rupees a ton. Domestic iron ore prices have likely bottomed out at a much higher level than historical level. The support has come, from the cost curve, which has moved up by 1,000 to 1,500 rupees a ton post auction of iron ore mine. At current iron ore prices, many domestic mines have become unviable. Some support has also come from improvement in domestic demand of steel, due to which the increased offtake from the infra project. Going forward, improvement in the prices of iron ore and pellet will depend on the impact of the export duties. However, downside remains largely protected due to the cost curve of iron ore. We can now open the floor for question and answer. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Prashant Kumar Kota from Emkay Global Financial Services. Please go ahead.
Hello, sir. Good afternoon, and thanks for the opportunity. And really appreciate the very detailed presentation and the data pack that you gave. It's like one of the best in the sector. So my question is regarding your view on iron ore pricing generally internationally and in India, and to that extent pricing of pellets. Assuming if you remove the government angle aside, just based on the current dynamics, what is your view and how do we see this from here, sir?
So it looks like the international prices at about $80 is almost maybe bottomed out to some extent. If the demand and the China stimulus comes through, then the prices should improve from here on rather than going down from here. The $80 should be the lower prices of the iron ore in international market.
Correct, sir. And your view on the domestic side, sir, pellet side, can we largely say they bottomed out after this government intervention, steep fall?
Steep fall has already happened in pellet prices. The rest of the steel prices, as you may be aware, in long products, the prices are more or less stable, maybe 1,000 rupees here and there. The prices are fluctuating, but mostly stable. Iron ore pellet prices have corrected only because of the imposition of export duty and, of course, the reduction in demand in international market. So, both have impacted the iron ore pellet prices, and we believe that iron ore pellet prices at 8,000 and maybe 5-7% down from here should be stabilized.
Understood, sir. Understood, sir. Sir, my second question is more to do with the social angle, social aspect of what you as a company do, sir. So basically, apart from running a profitable business for the shareholders, we also understand from our sources that you do a lot of CSR activities in the mining regions around your mines, sir. It's always very important to do that, given it's the local communities, development, upliftment, etc. So all those activities that you do are still continuing without any...
Yes.
Am I right?
I think we had highlighted at some point of time, we continue to transport our entire iron ore from mines to our plant is by the road. We have an opportunity to reduce the cost through by transporting the road, but in order to give the employment to the local population who are owning the trucks which are plying between the Godawari power plant and the mines exclusively, they get employment, and of course that has elevated our cost structure by 300 to 400 rupees a ton. But on account of development of the region where our mines are located, we are continuing with the road transport. Similarly, we have done a lot of CSR activities. I think each and every village, house is pakka now. There is a school facilities, there is a hospital facilities. All those facilities are available. The roads in the village are now pakka road. So all those activities are being continuous to be done by the company.
Great, sir. Really great. Really glad to hear that, and fantastic. And wish you all the best.
And as a company, we also believe we are supposed to give it back to the society. That is our responsibility.
Completely agree with you, sir. Fantastic.
Thank you. Thank you.
Thank you. Anyone who wish to ask a question at this time, they may please press star and 1. The next question is from the line of Jyoti Singh from Nuvama. Please go ahead.
Hello. Good morning, sir.
Good morning.
So I have 3 questions. One is, looking at your Concall numbers, I guess there are losses in your ferroalloy business. So in this case, how do you look at the demand and supply scenario of this segment, ferroalloy in India? Shall I go ahead with the other 2 questions?
Yeah.
So second is, as I have mentioned that you will be doing a capex as per the plan. Are you confident that you will be able to achieve the guidance of rupees 500 crore? Because in H1 you have done around 180 crore. So please let us know your plans regarding the greenfield steel project. And third is on your coal sourcing mix. So how do you think the coal sourcing mix look like, and how much coal did you import in your second quarter, and what is the inventory of coal as on date?
Dinesh, let me take these questions. Good morning, ma'am. Yeah, on the first question of ferroalloys, we need to understand India is a big exporter of ferroalloys. Whether it's silico, manganese, ferro, any kind of rice. And primarily, our biggest market is Europe, and you all understand because of the energy crisis in Europe, and ferroalloys being quite energy-intensive industry. So a lot of capacities have gone on in terms of steel making. If you understand, I was reading an article yesterday. So ArcelorMittal itself, alone as a group has reduced their production by almost 10 million tons across the entire Europe. So that is the reason ferroalloys prices have dropped significantly. That is one of the major reasons. And in India, there is an oversupply of ferroalloys. So export is part of, a good mix when you want to balance the entire demand and supply in India. So at the moment, I would see ferroalloy prices will be under pressure for sure, going forward as well.
Okay, that helps. Thank you.
Yeah. On the coal side...
Go ahead.
On the coal side, at the moment, I've told earlier this as well. We are importing coal for our DRI operations. We've always been doing that, and we still continue to import. We import from Africa, we import from Australia, and currently we imported from Russia as well. So depending, and as all are aware, currently finally the coal prices are starting cooling down. They've almost cooled by $100 in last 6 weeks. So we are trying to operate at minimum inventory so that we can take advantage of the lower prices. And for the power plants, we are sourcing domestic coal. We have linkage from Coal India as well as we buying from the domestic market.
Okay. And what was your coal import in Q2?
In terms of volume or in terms of number?
Both.
Okay, so see, we usually import on monthly basis or 45-day basis because we want to go with the market because the market is very volatile. So we imported about 1.5 lakh tons in Q2, and then the average price would be about 18,000 landed to plant.
Okay, and your capex guidance?
Dinesh.
Capex is like, as I said, we have done 179 crore in the first half. The major work on the solar power plant, where we have to invest more money, has started after the monsoon. So, except the capex on the steel billet side, everything else is expected to be completed in the current year itself, including the capacity for mining, both the solar power plant, 25 megawatt GPL, 60 megawatt Hira ferroalloys, and our replacement of turbine. So these are the main component of the capex, which is remaining capex and likely to be completed in the current year itself. So entire 500 crore, including 179 crore already done, will be completed in the current year.
Okay.
And if some is still over there, it could be, more before 5-7% of the capex here and there, but largely we are online.
Okay, that is helpful. Thank you.
And one more point I want to add about the loss in the ferroalloys business is we are holding a lot of inventories of manganese ore, which we had procured at higher prices, and same is getting consumed. Same was consumed during the last quarter and continues to get consumed, and therefore the impact of inventory loss is also there. As against the pellet inventory, where we are not impacted because our inventory of pellet was hardly 7-8 days, and iron ore is the cost is fixed because of the captive iron ore. So the inventory loss is mainly there with us in the ferroalloys business.
Okay, that was helpful. Thank you so much, and all the best for your future.
Thank you.
Thank you. Anyone who wishes to ask a question this time, they may please press star and 1. The next question is from the line of Mitul Shah from Reliance Securities. Please go ahead.
Thank you for taking my question. Sir, compared to Q2, how has been the trend during this October, November in terms of the demand situation? And also if you can give some details on the thermal coal price trend in current quarter compared to Q2.
Abhishek, you will take it?
So demand in terms of steel or demand in terms of overall demand or in terms of pellets? I'd like to clarify.
Overall demand and specifically to pellets, sir. As our pellets relatively better quality compared to...
Okay, got it. Yeah, right. So on the overall demand side, see, the demand has been little on the sluggish side because of the monsoons. Usually, in history, the demand is always on the sluggish side because of the monsoon season. And thus, there was a lot of correction because of the import and export duty. So, there were a lot of changes in the, supplier and the buyer side. Everybody was concerned about the prices further going down. So buying was a little skeptical. And with the monsoon over, so November to April is usually the peak period for steel industry. So we're hoping the demand should come back soon. On the pellet side, the demand is a bit good for us at least because out of the entire production, we almost produce 65% of high-grade pellets. So at the moment also, we stand an order book of, almost 45 days. So we have order books till end of December. So for us, on the demand side of pellets, we have no concern at all. We are very much covered for next 45 days and the materials are quite low in the plant for the pellet side.
So just a clarification, in initial you highlighted the demand was suppressed. That was for Q2 or for October? Because my question was primarily on October side.
Okay, so that was, I think, Dinesh ji mentioned that was for Q2. On the October side, again, I'm saying the demand was still sluggish because of the festival season. As I said, the demand usually picks up post-Diwali, which is November season. But on the pellet side, pellet being another raw material, considered as a raw material, so demand was still there back then and demand is still there right now also. And as I mentioned right now, we have order book of 45 days. So on the pellet side, we have no concern at all. Our order book is quite healthy.
And so during your discussion with your key major customers, wherein we are seeing that a definite slowdown on Europe side and China to some extent. So overall, global demand is under pressure. So what is indication coming from top client side during your discussion for next 6 months to 1 year point of view?
See, as you mentioned, I think it is very true. There's a global mentor in terms of steel production because of the energy. One is during the energy crisis and second is the inflation. Especially, with countries like Europe, they are going through heavy inflation. As I mentioned earlier, a lot of big steel companies are reducing their production as per the demand. But eventually, it's about, how competitive you are. And with our own iron ore mining, we see, if somebody has to die, we will be the last on the list, right? So as I said, we are very much comfortable in terms of demand level because our volumes are not so big. And on the pellet side, we have, been able to tap 3-4 big buyers in India, which are again buying from us. So I don't see any concern going forward as well.
Sir, in terms of thermal coal pricing trend compared to Q2, how has been the situation in October, November, current quarter?
See, usually what happens, we are usually covered for 2 months, with the inventory that plant, stock, and the material which is in transit. So the impact of the prices which have started cooling down will come in Q4 of this financial year. But at the moment, as I mentioned in the last call also, the prices currently stand at about 18,000 rupees a ton for a DRI. And for domestic, the average mix of linkage as the domestic purchase is about 5,500 rupees a ton for my power plant.
And sir, how has been the trend of the prices of this pellet price and steel prices in current quarter?
Post-Diwali, the prices have been quite stable.
Stabilized or still continue to decline in November also?
No. So pellet prices are hovering about 8,000 rupees ex-plant Raipur for the 60 pellet which is being manufactured by everybody else in India. And on the steel side, the prices are about 44,000 rupees billet and sponge is about 30,000 rupees. So market has been quite stable post-Diwali. There was a downfall pre-Diwali, but post-Diwali, the market has been stable. And we're hoping with the demand comes back, the prices should go up further.
So do you expect prices upward revision in coming months and Q4 or should stabilize?
It's very difficult to ascertain what prices should go up. But I think, as Dinesh mentioned, we feel the prices have bottomed out to a certain extent. We don't see a much downfall from here. Probably 5-10% here and there, you can't say. But we assume this is a benchmark where prices should not go below this.
Sir, anything on the hedging as currency fluctuation is too much this time, and we are doing sizable import of the coal and few other things. So,
earlier, it was a natural hedge for us when we were exporting pellets. So, natural. But after the exports have been stopped, so we do a close monitoring on daily basis. You keep a track of, the dollar fluctuations and all the news, rolling around it. For example, in last 2 days, dollar has come down from almost 82 level to 80.6 levels. So we keep a close track, and depending on the market situation, we keep hedging our import exposures.
So what would be the net exposure right now as a percentage of sales?
Foreign currency exposure?
In terms of import versus export, earlier as sir highlighted that we used to do sizable export, so it was a natural hedging. But now export has come down significantly and import would still remain same. So then what is the parity now net?
Our overall exposure in the forex market at Concall GPL level will be close to about 700 crores. Total exposure.
700 crores for this FY23 or now?
Yeah, at a time, as of now, it is close to about 700 crore of exposure is there.
Okay. So lastly, on the capex side, as you highlighted, 500 crores still we are maintaining, and there is no spillover, probably sizable spillover to next year. How one should look at next year's capex, or majority of capex is being done this year, or it will continue to in similar range next year also?
Next year capex we will be able to guide it by end of the current or maybe at the time of the Q1 call. We have to start the work for our greenfield distill project, but the land acquisition and the environmental approval both are delayed and it's taking time. So once we get the approval, then only we'll be able to guide how much of capex we can do it in the particular year upon receipt of that approval. Otherwise, whatever this capex which is currently going on is likely to get completed by the end of the year. So for next year capex, we will be able to guide in due course of time only.
But any indication directionally would be higher or lower than this current year? May not be the
maybe similar kind of capex in the next year. Close to about 500 crore in a year. It won't go much because when we get the approval, then we're going to place the orders for equipment, etc. So I don't think in first year it's going to go beyond 500-700 crores. And we will be able to meet that entire capex through our internal approval.
Sir, yeah, sir. Thanks. That's all. All the best, sir.
Thank you.
Thank you.
Thank you. Anyone who wish to ask a question at this time may please press star and 1. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Good afternoon, sir.
Good afternoon, Vikas.
Yeah. Sir, I just wanted to understand that at the high cost inventory, the entire impact has already been taken by 2Q, or some of the impact would flow into the 3Q, and how the blended price you are expected to move in 3Q?
No, most of the inventory related is already taken because we had an impact of inventory loss on manganese ore prices only. The rest of the prices are mark to market, and I don't think there is any major inventory losses there in the company. So it is mostly covered in Q2.
So the imported thermal coal, which would have come at a higher cost, that is also mark to market by 2Q, and 3Q we won't see any inflation because of that?
No, we won't see that.
Understood, sir. My second question pertains to our net cash. So if I just do the math, we would have earned some cash during first half, but our net cash position kept on declining. So barring 179 crore of capex, where the rest of the capex cash has been deployed, because I don't see much of the inventory creation for us during first half.
No. On net basis, the money has been deployed in capex as well as in the your current assets. If you see, my net current liabilities has gone down by 300 crore. and current asset has gone down by 100 crores only.
In addition to that, there is a dividend payout of 118
crore of dividend, 120 crore of dividend payout.
Understood, sir. And sir, during my first question, I also asked that how the average prices movement we are expecting in Q2 versus 2Q in our major products such as pellet and sponge pellet. If you could give us some insight into it.
With the current prices,
Can you come again, please?
So, current prices versus your 2Q average, how they have moved as of now for pellet.
On pellet side, the Q2 average was about 8150, and currently we stand about 8200, so it's almost the same level. On the sponge side, the Q2 average was about 33. Currently, the prices stand at about 30,500, so there's a drop of about 2,500 rupees. On billet side, the average was about 47. Currently, the price stand at 44. So there has been a drop of about 8% on sponge and billet side. Pellets remain the same.
Understood, sir. Sir, one more question regarding the international scrap prices, which have been on a declining trajectory. So does that impact our sponge and the billet prices domestically, or we remain fairly insulated? So what's your take on that?
See, when it comes to domestic industry, scrap prices do not affect so much. But what has happened lately, because of the domestic prices on the scrap and pig iron being high, a lot of people have imported bulk vessels into India for their own consumption as a trading. For example, even Godawari, we import about 50,000 scrap on annual basis. For the first time, we imported a bulk shipment of scrap, which is going to arrive in December. Because if you compare your melting cost versus sponge, so scrap melting is much more viable at the current level. So depending on the market situation, it does impact here and there. The impact is not very big, but it is there. You cannot ignore it.
Understood, sir. So just one last question regarding our solar power plant. So right now, if you could give us some idea about the cost savings per unit which we are having on that, and how does that move in couple of quarters down the line?
See, GPL 70 megawatt has already been commissioned, and we have started using the power in our steel melting plant, like the integrated plant at Siltara. There we are buying power from the grid at 5 rupees 50 paisa per unit. Now, so against this, our cost will be, less than 1 rupee 75 paisa, including the grid charges, the power banking charges. So net there will be more than 3.5 rupees per unit saving. The 25 megawatt power plant, where effective power generation will be about 4.5 megawatts, will be used in our mines. So mines, we are buying power at about 12 rupees per unit. The tariff or the grid tariff in the mines is higher. So that will be again replaced with what, the power cost of 1 rupee 75 paisa from the solar. So the entire saving will plow back to the profitability. So against 12 rupees, you can take 2 rupees as the cost. So 10 rupees saving is expected there. Similarly, in Hira Ferroalloys, because of the very high cost of coal, we are using the power from the grid rather than running the coal-based power plant. And same will also get replaced with the solar power by end of the current financial year. So net in our steel melting and ferroalloys business, we expect a saving of about 3.5 rupees per unit. And at our mines, our saving will be close to about 10 rupees per unit.
Understood, sir. Understood. Thank you for taking my questions, and all the best for future.
Thank you. Yeah.
Thank you. Our next question is from the line of Jatin from Invest Savvy. Please go ahead.
Yeah, hi. To continue with this, thanks for taking the question on the call. On the power saving, you said 70 megawatts, and on the other 25 megawatt plant, there will be 4.5 megawatts which will effectively be produced.
Yes.
So this is, while in megawatt terms this is fine, but how many megawatts are actually produced? Megawatt hours are actually produced. So, like for solar power, in a month, how many hours and how many days is it operational?
No. So just to clarify, it will be difficult to answer that very specifically. You can consider a 17% PLF on annual basis. For example, if it's a 70 megawatt solar power, so 70 megawatt into 0.17, so about 12 megawatts will be your generation throughout the year.
So 12 megawatts into 365 into 24.
Exactly. Yes. Yeah, into 1,000. So basically 12 into 24 into 365 into 1,000 means about 10 crore units annually, 10.5 crore units annually. That is how the calculation is done.
So basically you are saving 3.5 to 10 rupees depending. And this 4.5 megawatts is already taking the 25 into 0.15 and converting to 4.
Yes, exactly.
Okay. So this will show up in a cost saving, or it will show up as your
cost saving.
Cost saving.
So as Dinesh actually mentioned, in the mines currently we are importing power from the grid, and then the average bill is about 11.5 rupees per unit, which will come down to about 2 rupees. So about saving about 9-10 rupees there. And on the plant side, with 5.5 rupees generation cost on the coal side, it will save about 3.5 rupees. So that was Dinesh mentioned previously.
Even the grid power we are buying from the grid, small quantity of power from grid.
Yes.
Okay, because
Sorry, Jatin, your voice is breaking and we are unable to hear you very clearly.
So this, if I do a rough math, is a saving of about 75 crores a year, based on what you said. So that is obviously a very heavy number. Also, I have a question in terms of your impact of
Jatin, I'm sorry to interrupt you, but your voice is breaking.
Your voice is cracking, yeah.
Can you hear me now?
Little better, but request you to please come in network area.
Okay. If we look at the impact of dollar movement on your business, now is there a connection between the dollar, like the overseas price? You're saying $80 to $120 is what you expect it to trade at. Now, if dollar is moved up, then does that mean that your realization will be better in India?
Export is not allowed, my dear friend. Export is not allowed.
It's not allowed, but is there a relationship between the domestic price and the global price?
There is no relationship because in India, pellets are not getting imported.
No. What he means is, if the dollar is moving up, does the domestic price also start moving up? So I would say not relatively. For some people it might change. It might have an impact depending on the product cycle. For example, people who do engineering or depending on imports. But on a relatively on a larger scale, it doesn't impact so much. And right now the global prices of all the commodities or all the steel I would say production, the pellets, sponge iron, or long products, the prices are much less compared to the Indian domestic market right now. For example, billets right now, FOB Black Sea is about, it's about $490, which is about 40,000 rupees, and in rice bowl we're selling billet at 44,000 rupees. So it's only 10% higher. So right now the impact is not very relative compared to the dollar movement.
Okay. And historically, do domestic prices trade at so when exports etc. were allowed, and movement was happening, was the domestic price at a discount to the global price, or was it par to the global price, or is it below the global price?
See, it all depends on demand and supply. There have been times that domestic prices are much lower compared to the global side, so people start exporting more. When the domestic prices are stronger than the global, then people start supplying domestic more and reduce their export volume. So every company, depending on the market scenario, keeps changing their the supply mix to the domestic and the export market. It's a very volatile market right now. Yeah. So there are a lot of ifs and buts, a lot of reasons behind it. So it's difficult to give a one particular answer.
Okay. What percentage of your cost is coking coal?
We don't use coking coal because we don't have a blast furnace. We are in DRI route, so we have pellets, sponge iron, coal-based sponge iron, and then steel making to induction furnace route. So we only import thermal coal. We don't import coking coal.
Okay, and thermal coal is what percentage of your cost?
It's about 50% of my total import. So the total coal I consume in the entire operation, thermal import is about 50%.
50% is imported, and the rest is
domestic. Linkage
I can assume total cost, total raw material cost, it could be closer to about 10%.
Okay, so domestic. So the total cost of coal used is 10% of overall cost, or 10% of the overall revenue?
Yes.
No, revenue or cost?
Overall cost.
Cost, not the revenue.
Okay. So, thank you. And in terms of your operating margin, as we can see that, because of the factors you've been mentioning, we have seen a big drop in realization, and hence the EBITDA has dropped. But from 35% it came down to almost 17% earlier for the quarter. So 28 to 17. Now, do you think it bounces back from here, or stays here, or goes lower?
That depends on the opening of the market for export and what is the international scenario. Otherwise, the long-term margins are closer to 20%.
Right.
Sorry, I lost the last sentence.
No, long-term margin in our business is close to about 20%. But if an extraordinary situation arises, like last financial year, then the margin can go up to 35-40%. Last year we did 42% in H1 FY22. So that depends on the demand supply purely, and it's a commodity. So fluctuations are very wide.
Okay, so if you were to hazard a guess, assuming that exports not open for, let's say, the next 2 quarters, in this quarter and the next quarter, then, given all that's happening, you expect it to be around what it is, or go up marginally, or go down marginally?
We expect it what it is to be. That is where, 1-2% here and there, but mostly in this range. What we did in Q2. Okay, won't your power benefit actually kick into this then? Because now... Not in the current year. The major benefit will kick in the next financial year when the projects get commissioned. Some benefit will come from the project which is already commissioned. But then, as I said, 2-3% here and there could always be, fluctuation in the margin. And to that extent, it will get covered within that.
Megawatt plant, you said that was commissioned in June. So it became operational in June, or it became operational later?
No, it has already become operational. The impact of which will be felt from Q3, because in Q2 we had banked entire power, so it is valued at cost only. So Q2 there will be some impact, but then you have to see some prices have gone down in ferro sponge iron, some prices have gone down in billet. So that impact will also flow back. So on an average, it will be closer to 19-20% margin.
Okay. And the 70 megawatt plant, which was, I think, there from August, is that been commissioned, or is it going to commission?
No. It is commissioned, and we have started utilizing power from October onwards. For 2 months, the power was banked with the state grid. Okay.
So for basically both the plants, Q3 onwards, full benefit will come in.
Yeah, for 70 megawatts, Q3 onwards will come, and for the rest of projects which are under construction, the benefit of which will come in Q1 to FY24.
Thank you. Jatin, may I request you to please join the queue for any follow-up? Thank you. Also, participants, before I take the next question, I'd like to remind the participant to limit your question to 2 per participant. If time permits, you may join the queue for any follow-ups. Thank you. We have the next question from the line of Chintan Mehta from Lloyd LLP. Please go ahead.
Hello. Am I audible?
Yes, you are.
Yeah. So it's regarding the cost of iron ore. In the presentation you mentioned it's 2,900 rupees quarter on quarter. So I want to understand that this is including royalty. Hadn't the cost should have gone down quarter on quarter, considering the fall in the market price of iron ore, and royalty is a function of to a certain extent the prices of the iron ore. Don't you think that cost should have fallen by 200-300 rupees, sir?
No. So I just to clarify, what happens is we are supposed to pay royalty basis the IBM price which has been published. So right now IBM has printed the price of month of July. So there's usually a backlog of 3 months. So right now the royalty is being paid basis the IBM price published in the month of July, and we're sitting in October. So we expect as we move forward and the prices have come down, so there will be a saving on account of royalty.
And what kind of reductions do you foresee, sir, in that price? Because that will get converted into our EBITDA in that, one way or another.
See, so the system right now which IBM follows is, they calculate the average of the volume sold in particular state basis the top 5 miners. In Chhattisgarh, there's only one miner which is selling, which is NNDC. So that is the impact of royalty on account of the mechanism IBM is adopting right now. The impact won't be very, very significant. If it had been Odisha, because there are a lot of commercial mining happening, the impact is much more severe. But in the Chhattisgarh, the impact will be very minimal. Say probably in the range of 100 rupees maximum.
And that imparts us more confidence that the price has bottomed out, because NMDC sees kind of two royalty structure from the mine of Karnataka as well, where it has to pay premium royalty on an overall basis. So you think that NMDC's prices have somewhat bottomed, and that will be scope, then Raipur as well, or no scope of reduction? That's the right way of thinking?
So I did read an article, which has been respected chairman of NNBC, and he said the prices have bottomed out and we don't see any further correction. So, because of his statement, I'm assuming NNBC will not carry the prices further. So we don't expect much correction in royalty going forward as well.
Super. That's it from my side. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Yukansh Jeswani from Mittal Analytics. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, one question on your restructuring that you are doing. So we had bought in the assets from Alok Ferroalloy and Hira Ferroalloy. So just going through your group structure. So in Alok Ferroalloy, we own around 79%, and then another 8-9% is owned by Hira Ferroalloy, and 12-13% odd by Ardent Steel. While Hira Ferroalloy is our subsidiary and Ardent is our associate. So are we further looking to simplify the structure and bring in the remaining stake also from from Ardent and Hira into GPIL directly?
Hira will remain as it is. We don't intend to buy that in GPIL. And Ardent, yes, we intend to buy it at some point of time. We'll do the corporate action. But we are not in a hurry. That is within the group only.
Okay, got it. And also, Ardent Steel, we continue to maintain this 37-38%, or do we intend to sell this?
No. We intend to maintain that stake.
Got it.
Just to have presence in Odisha, we will continue with that.
Got it. One clarification, sir. A lot of has been discussed over your power investments and power costs. So, hello?
Sorry, come again?
Yeah, I'm saying a lot has been discussed on your power investments and all the cost saving effort that you are taking. So just one clarification. So post these solar power plants coming on stream, will be roughly 250 plus megawatt power capacity. So will we self-sufficient, or will we have some access to sell in the market as well?
We will be self-sufficient for our existing operations.
Okay.
Including whatever is capacity under commissioning, will be self-sufficient. For new projects, we will have to look for the fresh power projects. But for our existing requirement, we don't need any additional power from here on.
So I'm asking new project, you mean the greenfield, right?
Greenfield, yes. For existing requirement, the power will be self-sufficient.
Got it. So once all these power plants are commissioned, so by next year we can say on an average your per unit power cost will be below 2.5 per unit on an average.
On an average, yes. I think so, yes.
2.5 to 3 rupees, depending on the prices of coal. Yeah.
So overall, simplistically, in terms of margins, I mean, you guys must have done this working. So just to simplify for us, last year, full year, we had spent something around 200 to 20 crores on power. So that should come down to less than 100 crore, right?
No, in fact, the number which you are looking in balance sheet includes the fuel consumed in the pellet plant. So that will not be the correct, working.
Okay, because pellet plant will continue
we are already running the power plant captively, and the fuel for the power plant is clubbed into the raw material cost. So whatever power we are buying from the grid is classified into the power and fuel cost, plus the coal charged into the pellet plant is a coal gasification is charged into the power and fuel cost. But yes, our current cost of power is close to about 4 rupees per unit, which will come down to about 2 to 2 rupees 25 paisa going forward.
Okay, got it. And what is our entire power consumption, sir, in terms of units for this entire operations, the increased operations that we'll be doing in FY23 or FY24?
At full capacity, on any given day, the consumption will be about 95 megawatts.
95 megawatts. Got it. And sir, one last question on the ferroalloy. You said you had taken a maintenance shutdown. So in Q3 we will see some impact of it, or in Q3 we will be back to normal?
Q3 we should be back to normal, but normal is now not like last year because the prices have already fallen from 130,000 rupees to about 80,000 rupees. So production volume will be normal, but the realization and profitability will definitely be, as compared to last year, it will be lower.
No. Just to what Dinesh is saying, of course, price is taken care of, but on the volume side, Hira Ferro will be absolutely back to normal, but Alok Ferro, there will be some impact because still the modification revamping is going up, and the revamping will take into effect end of November. So there will be a reduced volume from Alok Ferro, like this quarter, Q3 as well. From Q4 onwards, we will be back to normal in terms of volume.
Thank you.
Thank you.
Before we take the next question, I'd like to remind the participants to limit their question to 2 per participant. We have the next question from the line of Aman Madresha from Augmenta Research Private Limited. Please go ahead.
Hello, sir, and thanks for the opportunity. Sir, can you please throw some light on the domestic market, like post-imposition of the export duty, the pellets were being sold in the domestic market. And generally, you have highlighted in your previous calls also that the higher grade pellets of 63 to 64% FE content don't have much takers in the Indian market. So what has changed, and how are these pellets being consumed by the domestic market or the domestic takers? Some highlight on this.
So see, on the pellet side, what has happened is, as you must be aware, as we go ahead, the quality of iron ore in India is going down. Odisha being one of the major suppliers of iron ore fines, which is the basic raw material for pellet. Earlier, the benchmark was 63, now the benchmark 62. So now the pellets produce, on average basis all over India is about 62.5, which is a high, aluminum silica content, and which is the mass production. In case of Godawari, the advantage we have is, one is the high grade pellets, where the FE is about 65, and we produce about 65% of the entire charge mix. So our buyers are totally different. Players like Tata, JSPL, Uttam Galwa, who are running the blast furnaces. The reason behind using our pellets and paying a premium is because of the high coking coal cost. The coking coal by the way still delivered to India are above 300, which gives them an advantage to use the pellets in the charge mix. So that is the prime reason we are still getting a decent premium over and above the other players in the market because of low alumina and higher FE. That is one thing. And on the 60 pellet side, the second advantage we have is, our phosphorus is quite low because of our own iron ore mining, because of which there are few players in the domestic market who specifically want the pellet because of the steel making. Because right now, everybody in India is, moving towards making quality steel. So phosphorus does play an important role. And, the average phosphorus all over India is quite high. So that is the reason, I keep mentioning again and again, when it comes to pellet for Godawari, we don't have any pressure in selling. Rather, we get a premium over and above everyone else in the market. For example, our Odisha plant in Ardent, which is based in Odisha, the average selling is about 6,500 rupees ex plant, whereas Godawari is about 8,000 rupees. So straight away, an EBITDA of 15 rupees a ton, which is huge in the volume game.
Okay, sir. That was useful. Thanks for the opportunity.
Thank you.
Thank you. Next question is from the line of Satyan Wadhwa from Profusion Investment Advisors. Please go ahead.
Just one question. In the breakup of power, how many units of power do you use in the mining operation for which you pay, 11.5, 12 rupees? Just trying to get a sense of what the saving on the mining side will be.
About 5 megawatt.
Sorry?
5 megawatt.
5 megawatt. Okay, great. Thank you.
Thank you. The next question is from the line of DB Jalan from KFG Securities. Please go ahead.
Yeah, looking to the cost saving and better realization of our product pellet and all that, can we safely assume that in quarter 3 and 4 the profitability will be better than quarter 2?
Jahanji, it is very difficult to predict the profitability. But yes, the range would be, somewhere closer to this, but there could be some variation here and there.
No, if the situation maintains the same, that about export and all that.
But some of the other input costs keep fluctuating, so it may not be exactly same, but the range would be closer to here only, at this level only.
Okay, thank you.
Yeah.
Thank you. Next question is from the line of Wayne Temelo as an individual investor. Please go ahead.
Hi, am I audible?
Yes.
Yes.
Yeah. So congrats on a good set of results given the circumstances, and thanks for taking my question. So my first question is, in the previous quarter, since the imposition of the export duties, the fall in realizations for pellets was a lot more than that of sponge iron. So management had guided that we would try to sort of push more volumes on the sponge iron front rather than pellets. But I have seen that we've sold a lot more pellets, whereas sponge iron volumes have slightly come down. So could you throw some light on that?
No. You see, we have a pellet capacity of 2.7 million ton and sponge iron capacity of 500,000, 0.5 million ton only. So, we cannot change the mix largely. You can do some arbitrage, but, whatever sponge iron we are producing, we are operating sponge iron plant at 100%. So beyond that, we cannot increase. So the pellet sales will continue, to the extent of 500,000 tons per month, per quarter. That will continue.
Okay, thank you. My second question is, on the pellet front, we're doing, 65% of high-grade pellets, and we're selling to bigger players like Tata GSP, like you mentioned. So you guys must be aware that Tata Steel has in this quarter, in Q3, they have a pellet plant in Kalinganagar, 6 million tons, I think. So given that scenario, I mean, do you have any outlook on, the demand for our pellets?
Yeah, I'm totally aware about the Tata Steel commissioning a new pellet plant. But as I mentioned earlier, the volume which we produce, and volume which the bigger players require, for example, Tata or being JSP or Concall. So I don't see any change in that. I think we'll continue to do business with all these guys. Because of only the reason is, till time coking coal prices are, at these levels, using our pellets will always be beneficial for their, total cost.
Okay, thank you. And one final question is there any update on, we were bidding for some coal.
So we are still trying. Now government has come up with 6 tranche of coal. We are started evaluating, all the options. And as we said earlier, we are still looking to acquire a coal mine, and we will continue to work on that.
Thank you. The next question is from the line of Ganesh as an individual investor. Please go ahead.
Sir, can you hear me?
Yes.
Yes.
Okay. Thank you for the opportunity. So I'm looking at our results in the corresponding quarter 2 years back. Q2 FY21, we made a similar EBITDA at that time also with the similar amount of pellet sales. But the gap between our iron ore cost and the pellet cost then compared to now we have 1,000 rupees more per ton. So what I'm trying to understand is the profitability, though the gap is 1,000 rupees more, is the profitability the same or similar because of higher input costs? And what are the input costs? Just wanted to understand that.
No, you have to reframe your question. You are trying to